The purpose of this presentation is to respond to common questions and feedback from the previously released Episode 3, The Magic of Contribution Margin presentation. To get the most value from this presentation, it is recommended that Episode 3, The Magic of Contribution Margin, has been viewed or listened to. It is also recommended to watch this presentation in a video format where possible to better understand the formulas involved. This presentation is not intended to replace qualified accounting and financial advice, and all viewers or listeners should complete their own research and investigations and not take any specific action based on this presentation alone. The opinions expressed throughout this presentation are those of the presenter, and while well researched and gained through decades of industry experience, they do not necessarily represent the opinions of FMS Support Services. Unless specifically mentioned, no assumptions should be made about the identity of any individuals, franchisees, or franchisors referenced in this presentation. Welcome. This is Sean Butcher again from FMS Support Services. This is a quick Q&A follow-up session to cover some of the more common questions received from the recent Episode 3, Magic of Contribution Margin presentation. Once again, a massive thank you to everybody who watched or listened on different platforms, and especially those who shared or left a like or a 5-star review, as that really helps. Subscriber numbers are also slowly growing, so thank you to everybody that has subscribed in anticipation of future presentations. If you think you're going to get future value from these presentations, then please subscribe, as it is very helpful, and there will be plenty more coming up as I get around to it. So let's kick it off with the first question. Is contribution margin the same as gross profit? Good question, but no. These are two different measures which are useful in different ways. Firstly, gross profit is your net sales, so sales excluding GST minus your cost of goods sold, or COGS, which simply means the cost of the goods you purchased to then sell to customers. For example, in a supermarket, this would be all your grocery items that you stack on the shelves. In a bakery, this would include your flour, your sugar, your icing, your other ingredients, and even the paper and plastic bags that you put your products in for customers. It doesn't include the cost of things that you aren't selling to customers, such as your staff wages, electricity, stationery, rent, etc. So gross profit is simply your net sales, which is excluding GST or consumption taxes, where applicable, minus the cost of things you have sold to your customers, which is once again a net cost excluding GST or consumption taxes. Whereas a contribution margin is slightly more complicated than that. Contribution margin is net sales minus all your variable costs. So variable costs meaning every cost that is directly linked to your sale. This does include your cost of goods sold, or your COGS, as we spoke about just before, but would also include things like percentage franchise fees, third-party delivery costs if you're a food business using things like Uber Eats or DoorDash, courier or postage costs if you're an online retailer posting or couriering things out to customers. However, it doesn't include things that are considered fixed costs or not changing in any significant way as a result of making a sale, such as your rent, your electricity, assuming that all your equipment was going to be turned on anyway, advertising, most of your overheads, and in a majority of businesses, a significant portion of your labor costs or your baseline labor cost, which is those staff that are going to be there and paid the same regardless of sales. For example, if you're operating a clothing store, you are going to have to pay at least one person to be there from open to close, regardless of your sales, even if you make $0. There may, however, be a small amount of labor expenses included in your variable costs, especially for things like commissions, bonuses, overtime, casual and contract labor, etc., which may be directly linked to sales in some cases. Basically, to determine variable costs, you need to ask yourself if a cost has gone up directly as a result of the sale. Okay, next question. Can contribution margin be used at scale? And by that, we mean at different volumes, different numbers, different sales levels, etc.? And the answer is yes. Contribution margin can be worked out from an individual item to the business sales as a whole, making it very versatile. It can also be used to work out break even and or profitability at different sales levels and for any period of time, such as a day, a week, a month, a year. It can also be used to calculate the number of products needing to be sold and or the required number of average customers to break even or achieve a certain level of profitability. So this makes it extremely versatile. Next question. Can contribution margin be used for service businesses? And the answer once again is yes. Service businesses follow exactly the same methodology. Step one, identify the sales earned by the service or the business as a whole, depending on what level you're wanting to calculate this. Let's say that you're a law firm, for example, employing a lot of lawyers. You could look at your hourly rate. You charge out your lawyers to customers, which might be, say, $600, for example, excluding GST once again. If you have 5 lawyers working, say 40 billable hours per week each, your total revenue will be $120,000 per week. Once again, that's a net figure excluding GST. Then step 2, you need to identify the variable costs associated with the service. Now, for simple terms, in this example, let's assume that these lawyers are all contractors who just get paid an hourly rate for their work. And if there is no work, then they aren't getting paid. This would make your main variable expense from the law firm, and the only one I can think of off the top of my head, the labor cost for these contract lawyers. Now let's pretend that that is $400 per hour that you pay your lawyers. So your firm bills the lawyers out at $600 per hour to clients, and the lawyers then get paid $400 per hour as contractors. So then you need to move to step 3, which is simply to use the same contribution margin calculation that we were using in retail businesses or hospitality businesses or any other type of business. So remembering that contribution margin is sales minus variable costs. Your contribution margin per billable hour of work is $200 or 33% in this example. You could also work this out across the entire week where billable hours or sales equals $120,000, which means the contribution margin of 33% equals $40,000 per week. If you then wanted to work out break even, you would need to understand your fixed costs such as rent or your office utility costs, computers, copiers, text, stationery, etc., etc. Or you could also work out your profitability with these fixed costs incorporated as well. Okay, moving on. Next question. Why did formulas for contribution margin dollars sometimes change? Now, this is in reference to the presentation, the main presentation, where different examples and scenarios were presented, which sometimes meant different information was available to start the calculations with. So in simple terms, the reason the formulas changed is because sometimes we had more or different information, which means we could either skip steps or extra steps were required. On the screen now, if I bring that up, are 3 examples of calculating the same contribution margin dollars on a product. So the first example there, for those watching the screen, is the most basic example, where sales dollars and variable costs, always net figures once again, are known. So the formula is quite simple. It's selling price per unit minus variable cost per unit. In this case, that's $10 minus $3.50 gives us a contribution margin for this product of $6.50. Second is the example where if the sales and the variable cost percentage is known, which is something a lot of industries would be very familiar with. For example, food franchises will often know off the top of their head that cost of goods is, say, 25%, and franchise and marketing fees are, say, 10%, which would give them a total of 35% for their variable costs. So in that example, the second example, the formula is the selling price per unit times 100% minus the variable cost, which would be $10 times 100% minus 35%, which next line down would be $10 times 65%, or $6.50. And then in the third example, for those watching on the screen, is an alternative where if your sales and your contribution margin percentage are already known, which some organizations will have calculated as routine, then it's just a bit simpler than the second example, because you don't have to calculate the contribution margin percentage. And that is simply selling price per unit times the contribution margin percentage. So in this example, once again, $10 times 65% gives you $6.50. So three different ways of calculating the formula there to get to the same answer, which is $6.50. The only difference is what information you started with. Now, I apologize if you're not watching the screen. That may be a little bit more complicated, but hopefully that made sense. Next question. Why did formulas for the contribution margin percentage sometimes change? Now, this is essentially the same question, except in relation to calculating the contribution margin percentage. Very similar to contribution margin dollars, the formula might be slightly different depending on what information we already have, which may enable you to simplify some steps. In the following three examples, which I'll bring up on the screen now, the contribution margin percentage is exactly the same, but we have different pieces of information to begin with, enabling the same answer to be arrived at in different ways. So in these three examples, we're calculating the contribution margin percentage value for a product. Now, this product, incidentally, has exactly the same expenses and selling price as the ones in the previous example. So in our first formula there, that's your most basic formula, where you just have the basic dollar information to begin with. In this example, we've got the contribution margin percentage equaling the selling price per unit minus the variable cost per unit divided by the selling price per unit, and then multiplying that by 100 to get the final percentage. So that is $10 minus $3.50 divided by $10 times 100, which ends up giving you $6.50 divided by 10 times 100, or 65%. In the second example, if you know your variable cost percentage already, then you can simplify this down a bit even further. If you know the variable cost, which in this example is 35%, then it's simply a matter of 100% minus 35% gives you a contribution margin percentage of 65%. And then in the third example, if you know the contribution margin dollars and the selling price, which in this case is $6.50 and $10 respectively, you've got the formula there of contribution margin percentage equaling $6.50 divided by $10 times 100, which gives you 65%. And once again, my apologies if you don't have the screen in front of you. That may have been a little fast, but if it didn't make sense, please feel free to view in a video format. Next question. How do we compare product sales at different price points? So this can be very useful in a range of circumstances, but one of the most common is when comparing the number of items that need to be sold at different price points. This can help evaluate whether promotions or discounts are effective and more or less profitable for a company. For example, and we'll bring this up on the screen, let's say you're a furniture store that normally sells 100 couches for $1,200 each, excluding GST, per month. Each couch costs the franchise $300, and they pay a 10% franchise fee on their sales. How many of these couches need to be sold at a sale price of $999, excluding GST, to calculate the same contribution margin? So let's bring that example up. So in your left-hand column, as you look at the screen, is your couches being sold at $1,200, and on your right-hand side is your couches being sold at $999. So let's work through this quickly. If you want to work out your contribution margin dollars on your couches at $1,200 sale price, it's a simple matter of $1,200 minus $300 minus 1,200 times your 10%, and that's to allow for your franchise fee. So in that example, $1,200 is your sale price, $300 is your cost of goods sold, or the cost of your couch, and the $1,200 times 10% is your franchise fee. So that's $1,200 minus $300 minus another $120. Gives you a contribution margin dollars of $780. So if you're selling 100 couches a month with a contribution margin of $780, your total contribution margin for those couches is $78,000 per month. Now, if we want to find out how many couches at $999 we need to sell in order to give us the same contribution margin, maybe because we're looking at running a special, the formula to start with to work out the contribution margin on the $999 couches is $999 minus your cost of goods sold, or the cost of the couch, which is $300, minus your franchise fee, which is 10% of $999. So that gives you the next line down of $999 minus $300 minus $99.90, or a contribution margin dollars of $599.10. So to work out how many couches we actually need to sell to give us the same contribution margin, we're dividing 78,000, which is the original contribution margin from the normal 100 couches that we sell, divided by our new reduced contribution margin of $599.10. And that gives us, rounded up to the nearest whole couch, 131 couches. So from working this out, we now know that in order to be more profitable than normal, the furniture store now needs to sell at least 131 couches at the new price of $999 to make the same contribution margin or profit that it normally makes selling 100 couches at $1,200. If it sells 131 couches or more, as opposed to the normal 100, then it is better off from a profitability perspective. If it sells less than 131 couches, from a contribution margin and profitability perspective, then the couch has contributed less than usual to the profitability of the business. Okay, next question. How easy is it to substitute sales figures in profitability calculations? Okay, that's very easy. If all you are going to do is rerun the calculation at different sales figures, it is as easy as you're going to see on the screen here. So in your left-hand column, you've got profit calculation on sales of $20,000 per week. And in your right-hand column, you've got profit on sales of $30,000 per week. In your left-hand column, with profit of $20,000 per week, the formula is, as you would expect, contribution margin dollars minus the total fixed costs. In this circumstance here, we're going to assume that the contribution margin percentage is 55%. So it's sales of $20,000 times 55%. minus the $10,000 that we're pretending are fixed costs. The profit of $11,000 minus $10,000 equals $1,000 per week. In your right-hand column, exactly the same formula that you've got contribution margin dollars minus total fixed costs, except the only difference in this situation in the right-hand column is that we're now talking about sales of $30,000 per week. So that's $30,000 times the 55% contribution margin minus the $10,000 in fixed costs, or $16,500 minus $10,000, giving us a profit of $6,500 per week. Now, you can probably note there that profitability has gone from $1,000 per week at $20,000 sales to $6,500 per week at $30,000 sales. And this reflects the reality and the importance of sales generation as the biggest key to profitability across most businesses. The reason for the increase in profit of $5,500 per week from $1,000 profit to $6,500 profit is simply because the business overheads and fixed costs were already paid for before the business hit $20,000 in sales, which means the next $10,000 in sales, the business was keeping the entire contribution margin as profit, which in this case was 55% or $5,500. This is where so many businesses go very wrong, is they assume that in this situation, if they increased sales from $20,000 to $30,000, their profit would simply go from $1,000 to $1,500 per week. However, the only circumstance where this will be true is if your business had no fixed costs at all. Otherwise, in every other situation, as your sales go up, the business profit percentage will almost always increase unless something has gone seriously wrong. Next question. How easy is it to substitute sales and contribution margin figures in profitability calculations? Now, this is something that is very common and for a good reason, because of the importance of trying to find the right balance between getting the maximum price for your product or service and still being able to get the most sales possible to ultimately make the most profit. However, the reality is, of course, that discounts, deals, promotions, and other similar things are extremely effective at increasing sales. But it will also cause your variable cost percentages to go up, which means your contribution margin percentage will come down. By this I mean, if you're a retail store or a hospitality business, for example, and you want to discount whatever you are selling for a promotion, then your cost of goods sold, or your COGS, percentage is going to go up. Example, if a cupcake costs you $2 in COGS and you were selling it for $6, your COGS was 33%. If you now sell it for $4, your COGS is now 50%. Now, once again, we're excluding GST in all these calculations. Other variable costs, such as franchise fees, where applicable, will normally stay the same percentage. But COGS is the big variable cost that you can almost always guarantee will go up as a percentage of your sales if you're going to bring your sale price down. So I'll bring up an example on the screen. And in this example on the screen, for those watching, is a business asking themselves the question of should they run some aggressive promotions, deals, or offers, or maybe even just drop their price to increase sales. So in the left-hand column there, we've got the profit of sales of $20,000 per week with a 55% contribution margin. And then on the right-hand side, we've got profit at sales of $24,000 per week with a 50% contribution margin. So in this example, the business on the screen believes that if they run some aggressive offers, deals, or promotions, or drop their prices, whatever they're planning on doing, their sales will increase from $20,000 per week to $24,000 per week. However, they also believe that their COGS will increase by 5% per week, which is probably a bit dramatic, but makes the figures easy to calculate and follow. Which means in this example, contribution margin is going to fall by 5% per week from 55% to 50%. So the question is, will they be more or less profitable? Now, I know the first reaction of a majority of people in franchising is going to be that they will be less profitable because most franchises have a major focus on cost of goods or COGS, and they probably should, especially from a control perspective to reduce wastage, shrinkage, theft, overportioning, overusage, etc., etc. However, when we look at these numbers, what we can see on the left-hand side is the same formula as on the right-hand side. It's contribution margin dollars minus total fixed costs. So the formula stays the same. On the left-hand side, we've got $20,000 in sales times our 55% contribution margin minus a $10,000 in fixed costs. Gives us $11,000 minus $10,000 for a profit of $1,000. On the right-hand side, contribution margin dollars minus total fixed costs, same formula, gives us $24,000 times 50% to calculate the contribution margin dollars minus $10,000. So that gives us $12,000 minus $10,000, or a profit of $2,000. So in answer to the question of sales of $20,000 per week with a 55% contribution margin versus sales of $24,000 per week with a 50% contribution margin, we can see that the profitability of sales at $24,000 per week, even with the lower contribution margin, is double. It goes from $1,000 to $2,000. Next question. What sort of businesses is the break-even and profit calculator designed for? Now, this is in reference to the free break-even and profit calculator that is available from fmssupportservices.com.au, which was also demoed in the main contribution margin presentation. Any business can use it, although it is probably most useful for businesses where sales are paid for at the time of purchase, i.e. not for businesses operating accounts with long trading terms. And this is just because cash flow will line up with profit and loss. If your exact expense type isn't listed, then consider placing those expenses in with something similar or in the miscellaneous expenses section. The calculations will still work. If an expense doesn't apply to you, then just leave it blank or enter $0. So don't feel you've got to enter everything in the exact description. The main thing that's important is to ensure that you enter variable costs as a percentage and fixed costs as a dollar value. All the calculator is doing is using the contribution margin formula to give you your profitability projections and your break-even calculation. Next question. Can we get the presentations out quicker? What is the schedule? Currently, we are aiming for at least one presentation per month. Unfortunately, this actually takes a bit longer than most people probably expect, or maybe I'm just very, very slow compared to average. It's also basically a community service, and there is no money to be made out doing this type of thing unless you're Joe Rogan, which I am clearly not, and get a truly massive number of listeners or visitors, which is not likely to be the case for me or these topics anytime soon. Nonetheless, we will persist as long as people find it somewhat useful. And then finally, if you have any questions, please feel free to email us at info@fmssupportservices.com.au for a personalized, confidential, and definitely free response. I should mention that all the questions that were here today have come through from listeners or viewers, and we responded to those people pretty much within 24 to 48 hours maximum. We just run a group presentation here just on the basis that if one or two people had the same question, then there's probably a lot of other people that had the same question as well, which is why we put it into this group presentation format. Otherwise, if the option is available at the point of download, please feel free to leave any comments or your questions in the comments section or on Facebook or LinkedIn, where you may have found this link, and I will get back to you as soon as possible. Remember that you can also follow us on Facebook, LinkedIn, YouTube, Spotify, Apple Podcasts, or wherever you download your podcasts. And there are plenty more presentations coming up. If you have any suggestions or requests for topics, please let us know and we will add them to the growing list. If you found this useful, please leave us a positive review and a 5-star rating, as it will assist the algorithms in sharing this with other people that may also find it useful. Otherwise, if you know anybody that may benefit directly, please feel free to share the link directly with them. Thank you, and I'll see you next time.